Risk management. What does that mean to you? It should probably mean a lot, considering that that's a vital part of your overall financial success, right? You need to know what it is, how to manage it, what to do about it, and I suppose know that you are doing it properly, because if you don't, you can lose both money and sleep over it. That's a bad combination from a health and well-being perspective. And then, speaking of health and well-being, we're going to talk about one of the most thankless jobs out there, and that is that of an estate executor, or perhaps a successor trustee under a trust after someone has passed. Wow, we have seen and heard stories that will just amaze you as to the struggles that that person that sort of gets left with all of those duties winds up going through. You can imagine you've got to track down assets. You've got to kind of be a little bit of a referee, because the beneficiaries are always chomping at the bit. They want the money quickly. And then there's a slew of paperwork that typically goes along with it, a quite thankless job. So on the show, we're going to talk about some of the pitfalls to look out for and what you need to be aware of before you ask someone to do those types of things after you are gone. So all of that coming up here on Dollars and Cents. Welcome in, of course, to the program. We're a long-running radio show, also a top 25 financial planning podcast out there on the big wide world web. My name is Joel Garris, a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we help people make better decisions with their dollars. To learn more about us, check out our website at nelsonfinancialplanning.com. There you can also meet the rest of the team as well, a bunch of certified financial fiduciaries, along with folks that have different expertise in different areas of your finances. So before we get started with all of that, speaking of the team at Nelson Financial Planning, once again, Nelson Financial Planning named one of the best places to work, courtesy of the Orlando Business Journal. Certainly nice to receive that recognition and accolade, obviously highlighting our companies just as a business, as an employer, commitment to maintaining a positive and supportive work environment. The accolade, of course, if you're familiar with it, is awarded based on a lot of factors, does a lot of employee surveying and satisfaction surveys and workplace culture and sort of overall company performance. So, yay us, that's good. And certainly, as an aside, I certainly get the privilege and honor of working with a really nice group of human beings every day here at Nelson Financial Planning. Busy week ahead as we think about the week ahead. Our fall series of client educational meetings starts up on Wednesday. If you're a client of the firm, you know that we believe very strongly in education and helping to educate our clients about what it is that they own, what's going on in the world around them, what's going on in the markets, all of those kinds of things we value tremendously. We have a live presentation, usually over dinner and drinks, so that's always good, and to help educate our clients on a quarterly basis. And then, of course, we have a series of things during the course of the year. Anyway, our sort of fall or third quarter kicks off on Wednesday, where we're going to learn about or talk about the impact of the One Big Beautiful Bill. We've certainly spent some time on the radio program during these past several episodes to talk a little bit about that, talk about the recent corporate earnings. And then, of course, the flip side is kind of what's going on out there economically, involving sort of that languishing consumer sentiment and languishing in terms of the labor market. Clearly, that's going to drive the Fed to perhaps get back to cutting rates in the next couple of weeks. They meet again on September 16th and 17th, so that is coming up. Speaking of labor market and consumer sentiment kind of languishing, that certainly was the economic data that came out on Friday. Latest jobs report, so obviously this was for the month of August. The expectation was that there was going to be a increase of about 75,000 jobs for the month. The reality is it was only 22,000, and even more troubling was the continued downward revisions in those numbers of job, with June actually getting readjusted down to a net loss of jobs that month of 13,000. So that, in perspective, was the first such decline in a month of jobs, going all the way back to December of 2020. What was even more interesting, and why this particular report, or the jobs report that was released on Friday, was watched at great length, is because if you recall sort of the other headlines, after the last jobs report, somebody lost their job at the Bureau of Labor Statistics because, White House didn't necessarily like the job numbers. Well, here you go. And there's new people at the helm, and I guess the data doesn't lie. You're definitely having some issues in the labor market. Expectation of 75,000 jobs created, and the number comes in at 22,000, along with further revision of the jobs data for June all the way down to a loss of 13,000. As we said, first such reduction in the labor force going all the way back to December of 2020. Layer on that, as you might well imagine, given kind of what this labor market data is showing, consumer sentiment also went down about 6 percentage points in August. That's after trending up for June, July. So you got a couple of big economic pieces of data last week. And as we think about the Fed meeting, not this coming week, but the week after, clearly the body of evidence is mounting about potentially cutting rates. So that's good if you're in the market for a mortgage or something along those lines as well. So all important stuff to be thinking about and considering as we think through what's going to happen over the course of the next couple of weeks. Also, speaking of sort of where we are in the calendar, hard to believe there's only about 3.5 months left in the year. Most importantly, some need to start thinking about some of the things that you have to do, right? Otherwise, you could wind up having to pay a penalty or taxes or the like. Chief among them, of course, is the required minimum distribution. Folks, don't forget to take your required minimum distribution from your retirement accounts. It is, in fact, a requirement that you must do if you are age 73 or older. Now, there's a special exception if this is your first year, where you can kick it to the following year so long as you take it out prior to April 1. But just know that if you kick it from this year into next year, then you're going to have to take 2 required minimum distributions in that year. So make sure, as we kind of start to accelerate to the end of the year 2025, that you take that qualified charitable distribution, because if you don't, there's a 25% penalty plus the taxes on top of that. The only good news I got there is it used to be a 50% penalty, so maybe it's not quite as penalized, but the reality is it still has a pretty significant impact to your wallet if you do not take that required minimum distribution. If you're charitable minded, let me use this as an opportunity to plug the qualified charitable distribution option. That is a great option if you give money to charity. There's very specific rules that you need to follow if you're going to take advantage of that. But the qualified charitable distribution does allow you to immediately or directly reduce down the amount of that distribution from your retirement account by those dollars. Those dollars, key piece here, is must go directly to the charity. They can't go to you and then you write the check. The check has got to go directly to the charity. Interestingly, that option still starts at 70.5, not at the required minimum distribution age. So a little bit of an opportunity for folks to do that, even though they might not quite be have that required minimum distribution. One other piece on this, this qualified charitable deduction thing was boosted courtesy of the One Big Beautiful Bill, expanding sort of the options. And then the IRS as well has kind of leaned into this with some new rules that are going to make it easier for people to remember and report this stuff properly on your tax return. We're going to have more on that in the months ahead as we start to see those forms. Anyway, we're going to take a break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Risk management, if you will, is this process of sort of identifying and analyzing and then ultimately mitigating the potential downsides of an investment while balancing the reward, right? I think that's the best way to put it, is this notion of when we talk about risk management, it's all about balancing risk and reward. Because at the end of the day, when you think of it, risk is in fact inseparable from return. Risk is inseparable from what we do on a regular basis, not just about our finances, but think about your daily commute. You're taking a little bit of risk there going and getting out on the roads and heading to your job, particularly if you're having to travel I-4 these days. And so if that's the case, what do you do to mitigate that risk? Well, you hopefully drive more carefully, pay more attention, stay off the phone, all that kind of stuff. And then that helps to reduce down the likelihood that you're going to die in a fiery crash on the interstate. So similarly, risk is also pretty important when it comes to finances. Any investment that you put your money in is going to have some degree of risk. Obviously, the lowest risk is typically if you are investing in U.S. Treasury bills, those kinds of things, or if it's cash at a bank. And then sort of on the other side of the equation, the sort of the higher risk categories would be things like emerging stocks, emerging market stocks, and then some of the other, kind of more crazy strategies out there with options and straddles, and then we'll throw in crypto into that category as well. So that kind of gives you the spectrum. Typically higher risk will come with sort of higher reward. Let's hope you're getting a higher reward for the risk that you take when you're taking on more risk. But from an individual's point of view, it's important to be able to sort of stomach that, right? I mean, if you're chasing return and creating an excessive amount of risk and you're waking up in the middle of the night and your stomach's churning, then perhaps you need to engage in a little bit more risk management as it relates to your personal finances. So one of the ways in which you do that is, you kind of look at this concept. There's a way to sort of the standard classic way to sort of measure risk in a investment portfolio involves looking at a concept called standard deviation. Okay, so what standard deviation is, simply put, is that's sort of like looking at sort of a dispersion of the returns of a particular investment over time, right? So it's sort of a statistical thing that looks at sort of how the returns vary from one period to the next versus the average, right? So we'll give you an example. So let's say you've got an investment that on average has an annualized return of 10%, right? But yet that investment can swing by 40% on a regular basis. Hence the standard deviation is quite high. So to get the 10, right, then you've got to be comfortable with these swings of 40% on a somewhat regular basis. On the flip side, if there's another investment that, maybe it doesn't make as much as, let's say, that 10%, maybe it only makes 9%, but those swings, instead of being 40%, well, those swings are only about 15%. So that's a good example of where risk management comes into play, and beyond just, okay, I've got this much in stocks, this much in bonds, and this much in cash. That obviously is a very classic way to manage risk, because stocks generally have a potential for greater appreciation but more volatility. Bonds, less return but less volatility. Cash, obviously not much of a return, but you don't have to worry about any kind of volatility on it. But beyond that, even in the different categories, you can have in specific investments that would have a much greater level of volatility. And the traditional way, of course, to measure that is through standard deviation. So that concept of standard deviation, which is a very technical kind of concept when it comes to the financial world, really does help to help folks to understand sort of the volatility of their potential volatility of their investments. And then that obviously allows you to make more informed decisions. And this applies to whether you're thinking about your individual situation. It also applies to the economy as a whole, right? I mean, if you think back to sort of the Great Recession of 2007, 2008, I mean, the thing that sort of precipitated all of those dominoes falling was that you had a bunch of mortgages that banks were giving to people without really any regard for their credit rating or their income. I remember those days, frankly, quite well. The expression that I would use back then is, well, if you can fog a mirror, you can get a mortgage. And at the end of the day, that was almost what it was. So guess what happens then if you're doing that from a lending perspective? Chances are you are lending to folks that would be not highly likely to pay you back. And so consequently, a much higher risk that then becomes part of the overall economic system. And then when that risk comes home to roost, so to speak, then you wind up having a significant economic event. So some important things to really kind of be thinking about when it comes to risk, what it is, how you look at it, how you measure it. And then lastly, when we think about some of the key takeaways as an individual investor, and we talk a lot about this in our book, Next Gen Dollars and Cents, soon to be released companion workbook here at the end of this month. So you're going to be hearing more about that here in the episodes ahead. But one of the sort of core tenets of what we talk about in the book is this notion of diversification, right? Obviously, spreading your investments across stocks, bonds, cash, each one of which serves different roles in the portfolio, helps to diversify, and then that diversification helps to reduce risk. Another part of risk management is what we alluded to in the past, and that's sort of the stomach test, what we like to refer to as understanding what your risk tolerance is, right? It's one thing to say, hey, I'm looking to get a return, but I'm going to literally throw up if I see the portfolio go down in value by 5% or 10% or whatever the number is. So it's important to understand what you as an investor can tolerate. And some of that involves setting sort of clear financial goals and sort of regularly reviewing the plan. Obviously, we would recommend, and this may be somewhat self-serving, but meeting with a fiduciary financial planner to help personalize that strategy and to work at making sure that there's a good understanding of what exactly you need to do to help manage that risk as best as possible. Look, at the end of the day, every investment has risk. It's just a function of balancing out the reward that you're looking for versus the risk that you are comfortable doing. And for that, you really do need to have a deeper analysis into the underlying components of your portfolio. That's why we're big proponents of doing things like x-rays of people's portfolios that really help to quantify that and come up with things like standard deviation and the like that gives us an insight into the risk in your portfolio. So with that, we're going to take a break and continue on the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. In this segment, we're going to delve into the often overlooked and highly thankless role of being the executor or personal representative of somebody's estate, or perhaps being the successor trustee under their trust. We're going to explore sort of some of the common pitfalls that befall folks in those roles, and some of the things that you can do to help avoid those pitfalls for whoever you have named. So, if you've ever been named an executor or successor trustee, there is a certain honor to that, right? I mean, it is nice that somebody thought of you as trustworthy and diligent to be able to say, hey, you know what, after I'm gone, I want that person to be able to take care of things once I've gone. And obviously, so that's nice, but there's a big but there. It comes with it a lot of pretty significant responsibility. And many people, we see this on a regular basis at the office, just somewhat unprepared for the complexities and the challenges that come with this role. I was just talking with somebody on Friday about this very thing, and they had just tried to really kind of get a handle on it, and still having to figure out where assets are and to go through a probate process. So, we've also seen certainly plenty of cases due to those complexities and challenges that where folks say, hey, you know what? Thanks, but no thanks. I'm out. I'm going to decline it. Personally, on a personal basis, I've declined a few myself when I have learned that, the kids are chomping at the bit. They don't really like their siblings or whatever the case may be. So we're going to start this discussion by talking a little bit about some of the common pitfalls and issues that you might encounter as an executor or successor trustee. The first is that there is a lot of legal and financial responsibilities to this. And, not everybody is familiar with those. So it's easy to not have the full amount of understanding of kind of what's involved with managing sort of the decedent's assets, paying off their debts, distributing out the remaining assets to the beneficiaries. And the process can certainly be quite overwhelming if that individual is not very familiar with the legal or the financial terminology. More often than not, you wind up hiring an attorney. That obviously adds cost and time and all of those kinds of things. But sometimes you don't, you just need to do that. I mean, I recall a situation that we've been working on with an individual, and this involved an insurance claim with a large insurance company. And the insurance company, there was just a little bit of a language tweak in terms of who the beneficiary was and who the beneficiary thought, who they thought the beneficiary was. And so, the insurance company's like, you know what? They don't really have an incentive to pay out. They'd rather hold on to the money. And so going around and around and around, and I'm sure that this has probably happened to you where, you call one of these 1-800 numbers, right? And then, somebody tells you one story and you do that. And then, and then that gets rejected and you call again, same 1-800 number, you get a different person, and then they give you, oh, well, no, if you did this, then do that and that will work. And you do that, and then that doesn't work, call again, you get third hand. You know where I'm going with this, right? So in this case, we finally said, well, look, you're just going to have to hire an attorney on this one because they're just not, they're changing their story on such a regular basis. So just know that that's sort of pitfall number one. Pitfall number two is, of course, the obvious, which is there could be some family conflicts, right? Our view, and this may be jaded, but beneficiaries are always chomping at the bit to get the money. I mean, there's no other way to put it. So you're going to have to go through and communicate clearly, manage expectations as best as possible. Sometimes that in and of itself can be a process as you're having to maybe track down people or maybe you don't know where they are, or maybe you don't know if they're still alive. Remember one situation where they weren't even sure whether, did this person have any kids? Were they ever married? Just didn't know any of that. And then to layer it all on, in that particular case, some of the beneficiaries were potentially minors, which opens up a whole nother can of worms. So be prepared for kind of those family conflicts. And then, as you might well imagine, sort of the third pitfall in all of this is you're going to need to spend a bunch of time, right? The time management aspect of this can be quite a lengthy process, taking oftentimes several months to years. And obviously, if you've been named as an executor or successor trustee, you probably have your own life and job. And so it is a considerable burden to try and balance that. And for many times, it can be sort of an Easter egg hunt, if you will, where you're trying to figure out, okay, what'd you own? Who did you owe? I got to pay the creditors. I got to pay the taxes. I got to distribute out the assets. So it takes a tremendous amount of time. And then lastly, of course, if something takes time and you're having to deal with a lot of interpersonal conflict and a bunch of legalese and financial, well, then it's kind of hard work. And so if anything, there can also be harder depending upon the assets that we're talking about, right? If it's a house or if it's a business, then you might really have to kind of go through that process pretty in depth. I suppose it's easy if it's liquid assets like stocks or mutual funds or whatever, but even that requires some logistics. Oftentimes when you're dealing with investment accounts, you need something called a medallion signature. And if you've ever had to look for one of these or ever had to get one of these, you know that it is not easy to find this. This is like a not even a notary on steroids describes what a signature guarantee is. It's a whole nother level. The signature guarantee stamp is in fact viewed as a cash equivalent type of instrument. Like that's how it has to be put under lock and key. We have one obviously at the office, and it's under lock and key. Only when it is used, it's out of the box. Otherwise, it's under lock and key because it really is a very different and very unique process where you are literally guaranteeing that the signature on that document is in fact that person. So we've had law firms reach out to us, law firms that we work with on a regular basis, and say, hey, can we come by and have you guys signature guarantee this, because we can't find any other place to do it. It used to be banks had it on a regular basis, but even that it's very hard to do that. So just know that those are some of the pitfalls, if you will, in terms of if you find yourself being an executor or a successor trustee. So how do you, as an individual, help out that person that you're going to name in this highly thankless role? We've got some good tips for that as well. And it starts with making sure that the person that you have named is, in fact, up to the task. So make sure you kind of revisit it on a regular basis. A relative may not be up to the task. One of the kids may not be up to the task, especially if that bothers the other kids. Naming two kids is maybe better, but at the end of the day, you could also cause a stalemate as a result of that. Hence, we often see people sort of looking for impartial sort of third parties like a lawyer, a friend, accountant, those kinds of things. So it starts with, in order to help out your future executor or trustee, it starts with making sure that you are picking the right person for the job to try and minimize those conflicts as best as possible. We got a couple of other thoughts as well on this, which we will get to after the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're talking about the thankless job of what it means to be an executor or a successor trustee, and just so many pitfalls when you think about that role. There's a lot of legal and financial responsibilities that come with it. You've got to pay off, you got to track down assets, you've got to pay off debts, pay taxes, and then, distribute out the assets to the beneficiaries. Oftentimes you got to, phone a friend, otherwise a lawyer, and get them involved, which only kind of expands out the time of the distribution, and also, of course, increases the costs. You've got to navigate the family conflicts. There's always that. It's true in every family, and if anybody tells you that my family is perfect and there's no dynamics of any kind, they probably got their head in the sand. So you got to keep them happy and figure out a way to communicate clearly, manage expectations in terms of timing. That's probably the biggest issue because they're always chomping at the bit to get the money. We've been accosted at a funeral one time when we were serving as a successor trustee, trying to be asked questions about the trust. And I'm like, I don't think this is the appropriate venue for this. We'll talk about it later. So you got to be able to manage the family conflicts, and then it's going to take some time, no question. You probably got a life of your own. You probably got things to do. It's a tremendous amount of time that can be involved. And fundamentally, it's hard work, tracking down some of the things that are needed. It gets harder if there's sort of real estate or a house or rental property or a business. I mean, my goodness, you can really find yourself having to do a lot of hard work on this. So those are the pitfalls. So then what are some of the key suggestions, and we've got 3 of what you need to do now to perhaps make your executor or successor trustee's life a little bit easier. The first one we talked about before the break, which is make sure they're up for the task, right? And make sure that you are reviewing that on a regular basis as well, to make sure that they are still, in fact, still up for the task. Number 2 is, my goodness, make sure you take the time to get the right legal documents in place. And for the love of Pete, make sure that you are going around to each of your assets, everything that you own, and make sure that you ultimately wind up getting the right documentation for each one of those accounts, and make sure that each one of those accounts have named beneficiaries on them. That's an easy process to do on most assets. And if you do that, then all of those assets will avoid probate, will avoid the entire process, because if someone's a named beneficiary on an account, all they need to do is present a death certificate, sign paperwork, and the account is theirs. Could not be easier, could not be simpler. So really, it's incumbent upon you to make sure you've got the right legal documents in place. That's the first part of that. But then to really go through your various assets and accounts and make sure that you have properly named beneficiaries on each account that you have, and spend some time double checking and reconfirming that every few years. That'll solve a tremendous amount of problems. The worst thing that can happen is not having any kind of estate planning documents, or not bothering to put a beneficiary or anything like that on a particular account. All of that is just going to create a big hassle and a big nightmare for your executor or your successor trustee. The third one is some advice, and that is that you can certainly start to manage people's expectations. Remember, we said that was one of the pitfalls of being an executor, is oftentimes people don't really talk to their beneficiaries about what the story is. And then the beneficiaries, more often than not, are quite disappointed with the amount of dollars that they got. I think many people think, oh, I'm going to wind up inheriting a ton of money. Okay, but more often than not, that's not really the case. After taxes get paid, after expenses get paid, after medical bills get paid, average inheritance in America is under $50,000. So if you're thinking that an inheritance is coming your way to solve all of your financial problems, let me assure you, it's not. You can help your future executor or future successor trustee by managing those expectations, by having open conversations about making sure that you are explaining exactly what it is that you have, what people can expect. And one of the best ways to do that, which is kind of goes hand in hand with making sure you've got the right legal documents, is that you really need to sit down and prepare almost sort of a separate writing of, here's what I own, here's where it's at, here's the account number, here's how you get in touch with them. Really take the time to go through that exercise and put all of that together. That's going to make life so much easier for your executor or your successor trustee, is to kind of have that separate document that has all of the various details, the logins, all of that stuff, all in one place, because certainly there is a tremendous amount to navigate through all of this. So those are some key takeaways, right? Make sure you're picking the right person to make life as easy as possible on your executor or your successor trustee. Get the right legal documents in place, and make sure that you are reviewing and what those beneficiaries are on the different accounts, and then spend some time managing expectations. Explain to people, hey, here's what's going to happen, and rough amount, if you will, that is heading in your direction. And then lastly, you can really help by putting together that detailed document describing accounts, addresses, account numbers, beneficiaries. All of that in a separate document really does help make things easy for your executor or successor trustee. Otherwise, you may find that they're just going to, after you're dead and gone, they're going to resign and say, I want nothing to do with this. So some important things to be thinking about. Similarly, if we think about some of the things that we talked about earlier in terms of risk management, had some very practical tips in that segment of the program in terms of how you manage risk in terms of your own personal finances. It obviously starts with diversifying your investments, but make sure that you also understand that inside of your investments, every investment is going to have some level of risk. We gave the example of two different investments, one which had a slightly higher return historically than another, but also had a much higher standard deviation or volatility associated with achieving that return. So it really is about sort of balancing that risk with the reward, which then means that you've got to understand what your risk tolerance is to know what you can stomach, because that's going to be directly correlated to making sure that you've got the right investment allocation. And of course, behind all of that, it's about setting clear financial goals. Make sure that what you're trying to do from an investment perspective, from a return perspective, is in fact a good match for the goals that you're trying to achieve. And then lastly, of course, and I guess this would be the shameless plug, make sure you take the time to meet with a fiduciary, a financial planner who is a fiduciary, whether that's a certified financial planner, certified financial fiduciary, whatever the case may be, to really help to bring some perspective into exactly what that overall investment mix looks like, what that overall risk level looks like, because it's so important to sort of manage this risk because it's present everywhere. It's present when you get in the car and drive to work. It's certainly present throughout all of your finances, in particular on the investment side. So some things to kind of be aware of when it comes to understanding what risk is and how best to manage that. And certainly that's where we come in at Nelson Financial Planning. We certainly help people make better decisions with their dollars every single day. So if you're interested in learning more about who we are, visit our website at nelsonfinancialplanning.com. There you'll see everything and anything from blog posts to biographies about the other members of the team here at Nelson Financial Planning. You can also find the various icons that will connect you over to our channels on the various podcast platforms, including our YouTube channel as well. Once you go through that process, make sure you subscribe along the way. And then, of course, if you're interested in having one of those free conversations with a member of the team, fill out that Contact Us form on our website at nelsonfinancialplanning.com. This is Joel Garris of Nelson Financial Planning. You've been listening to Dollars and Cents.